Welcome back to Stock Smarts, the channel where we help you invest with clarity, conviction, and confidence. Today's topic might surprise some of you. Why real estate investment trusts won't make you rich. Now, don't get me wrong. Real estate investment trusts serve a purpose in any balanced investment portfolio. They provide steady income, reliable cash flow, and exposure to property assets without the headache of actually managing real estate. Now, but here's the truth that most people don't talk about. Real estate investment trusts are not designed to multiply your money. They're built for income. They're meant to preserve what you have, not turn thousands into millions. Let's break that down. So, first off, real estate investment trusts are really built as income vehicles, not growth machines. Their main purpose is to collect rental income from properties like malls, offices, warehouses, or even hospitals, and then, distribute at least 90% of that income to shareholders. Because of this rule, they don't actually retain earnings to reinvest. That means, no aggressive business expansion, no big acquisitions funded from profits, and just minimal internal growth. So, while you do get those consistent dividends, you also get limited capital appreciation. Over 10 or 20 years, that can honestly be the difference between a solid retirement fund and just some passive pocket change. And second, real estate investment trusts are pretty sensitive to interest rates. Whenever interest rates go up, their prices tend to go down. Why is that? Well, because people usually shift their money to bonds and time deposits that offer safer, higher returns. If your real estate investment trust is giving 6%, but government bonds go up to 6.5%, investors will choose the lower risk option. That puts pressure on valuations. Third, they don't always benefit from booming property values. Even if the real estate market goes up, these trusts are bound by lease contracts that might not adjust quickly. So your dividend doesn't necessarily increase just because land prices in Bonifacio Global City or Makati go up. And most real estate investment trusts hold mature, stable buildings, great for rent, but not great for fast value appreciation. Fourth, they can't reinvest fast enough. Unlike growth stocks that reinvest profits into research and development, marketing, and scaling, real estate investment trusts have to pay most of it out. Yes, some can raise funds through debt or follow-on offerings to acquire new assets, but that's slow and limited by market conditions, which brings us to fifth, they depend on the property cycle. When occupancy drops, like what happened during lockdowns, earnings take a hit. And unlike tech or consumer companies that can pivot fast, real estate investment trusts are stuck with long-term contracts and physical assets. It's not agile money, it's slow, steady money, which is great if you're retired and want income, but it's not going to give you explosive wealth. Sixth, they are high yield, low growth. That's the trade-off. You're earning 5%, 6%, maybe 7% annually in cash, but don't expect your shares to triple. Contrast that with stocks in growing sectors like technology, logistics, or renewable energy that can reinvest heavily, expand margins, and capture new markets. Those are the kinds of assets that build wealth over time. Real estate investment trusts, they just pass on rental income. You're not buying the next big thing. You're buying the equivalent of a well-managed apartment complex. Stable but not scalable. Seventh, they're better at preserving capital than multiplying it. That's their real strength. If you have 10 million pesos and you want steady cash flow, real estate investment trusts are a great tool. But if you only have 100,000 pesos and your goal is to become a millionaire, they probably won't get you there. Why? Because even if you reinvest your dividends, the overall growth will still lag behind equity investments that grow around 10 to 15% annually. Before we go deeper, if you want to know more about investing in the stock market, check out the links down below for our books and online on-demand seminars. We've helped thousands of Filipinos start their investment journey the right way, and we can help you too. Now back to the topic. 8. Real estate investment trust prices don't move much. While stocks can fluctuate daily with market news, they often trade in a narrow band. This means fewer opportunities for short-term trading, price surges, or momentum plays. If you like action, these trusts will feel boring, which is fine. Again, they're built to be boring. But that also means less potential upside. 9th, they aren't great in inflationary environments. You'd think that because they own property, they'd benefit from rising prices. But in reality, rising costs eat into their margins. Maintenance, taxes, interest payments all go up. Meanwhile, rental income might be locked in fixed leases. So the spread between earnings and expenses tightens. Unless they renegotiate faster or expand aggressively, earnings growth stays flat while your expenses go up. 10th, not all real estate investment trusts are equal. Some are concentrated in one area or sector, like office spaces in Ortigas or malls in Metro Manila. If that area slows down, performance suffers. The diversification across asset types and geographies helps, but many local real estate investment trusts are still quite narrow in focus. Compare that to owning shares of companies with diversified revenue streams, foreign operations, and tech adoption. They have more tools to adapt and grow. So, what's the bottom line? Now, real estate investment trusts won't make you rich, but they'll help you stay rich. They're best used when you already have a big base of capital, you're nearing retirement and want cash flow, you want stability over high risk, or you're looking for passive income while your capital is protected. But if your goal is to grow your wealth exponentially, these trusts should be just one part of your portfolio, not the main driver. Balance them with growth stocks, index funds, or even global equities if your goal is capital appreciation. To wrap it all up, real estate investment trusts give you cash, not explosive growth. They preserve, not multiply wealth. Their upside is capped by how much rent they collect. They're slow to grow, slow to adapt. They protect you in downturns, but won't make you rich in upturns. Thanks for tuning in to Stock Smarts. I hope this gave you more clarity on where real estate investment trusts fit into your investment strategy. If this helped, don't forget to like, comment, and subscribe. We'll be back soon with more investing wisdom to help you grow and protect your wealth. See you in the next video.